You have a clear £50 million ambition, but every time you try to scale, internal bottlenecks stall your progress. The weight of that growth is fracturing your existing foundation. This chart shows a massive global shift in how businesses address that exact problem. Between 2019 and 2025, the number of advisory board professionals exploded from 1.3 million to over 9.8 million. North America currently leads this movement, accounting for over half of all global adoption, while emerging markets are rapidly accelerating to close the gap. Looking at this data on organizational motivations, the primary driver for this surge is clear. Founders are actively seeking independent input to achieve growth. You cannot scale past your own governance ceiling. Formalizing external advice provides the structural framework necessary to break through that barrier. When the ultimate goal is raising capital, having a strong product is insufficient. Investors are pricing in your governance maturity and the clarity of your story. This breakdown of the laws of capital raising shows that a compelling narrative and structured problem-solving build trust in stages. You have to secure an investor's conviction before they ever open a data room. Tracing this maturity curve, we see that achieving serious market signaling requires moving past ad hoc, informal coffee chats and establishing a highly structured strategic advisory board. Securing capital requires building a disciplined brain trust that clearly signals market readiness and systematically mitigates investor risk. The process begins by hiring an independent certified chair. They act as the architects of your strategy, designing the governance system rather than just facilitating a monthly meeting. They implement the ABF 101 best practice framework, starting with clarity of scope. This establishes the exact boundaries of the board and defines specific, measurable targets for the fundraising goal. The second pillar is structure and discipline. This sets the strict protocols for meeting cadences, ethics frameworks, and internal reporting mechanisms. Looking at this diagram of common board configurations, we see the most widely adopted model. The chair utilizes their global network to recruit specific expertise, typically bringing together 2 internal representatives, the independent chair, and 2 external advisors. Rushing into boardroom discussions without this disciplined establishment phase guarantees structural failure, wasted time, and lost capital. With the structure defined, we have to look at the financial mechanics of securing this level of specialized expertise. Early-stage startups often rely on equity, which accounts for about 8% of compensation models, to align long-term incentives. However, mature businesses operate on a different standard. This data on remuneration types reveals that the global standard for the business sector relies heavily on monthly retainers at 27%, followed by half-day rates at 16%. In corporate environments and mature family businesses, those monthly retainers routinely scale upwards of $5,000. This 40-minute discovery framework addresses the hesitation around upfront costs. It is designed to quickly identify the specific governance gaps currently stalling your £50 million ambition. It directly answers ROI concerns by proposing a strictly defined 3-month establishment pilot, lowering friction while proving tangible value. Professionalizing your board's compensation directly aligns your advisor's financial incentives with your aggressive timeline. Once the board is built and the pilot is proven, you enter the execution phase to secure the capital. Here, we see how the board leverages specific capital raising principles in action. Law 1, the anchor law, dictates that your first committed investor sets the price and terms for everyone who follows. Securing that anchor immediately triggers Law 5, creating contagious momentum, as remaining investors move faster when they see capital already committed. The board then enforces Law 6, the urgency law. Setting a hard, final close date drives professional discipline and forces the room to make firm decisions. Throughout this high-pressure process, the board continuously measures its own impact against the original charter and maintains strict ethical independence. During a volatile capital raise, a board provides the objective discipline that founders cannot reliably enforce on themselves. After the capital closes, the strategy pivots. The board focuses on deepening existing investor relationships and expanding wallet share to secure commitments for future funds. The advisory board functions as a permanent, protective governance ecosystem that continually supports the organization's evolution. While the strict establishment phase secures the capital you need today, the ultimate objective is compounding that stability and trust over decades. Stop stalling your own potential. Begin scoping your advisory board strategy today and build the foundation your ambition requires.